Okay. Okay. Well, hey, everybody. Welcome to Steve Cooper's podcast for aspiring real estate investors. In each episode, we aim to connect with seasoned investors and subject matter experts who are going to share some tips and tricks and help us learn more about what we can be doing when we're investing in real estate. Now, before I go too far down the road, I'd like to make sure I remind you all to subscribe, hit the like button, share this if you like it. Make sure that you're catching the latest and greatest when it comes through. So today is a really important day for me because I get to introduce one of the people I think that's brought more to the table in investing strategies than most. If you were to ask any Canadian, do you want to be able to make your mortgage tax deductible? Well, this is the man that's going to help you answer that question and find a way to do it. So, ladies and gentlemen, without further ado, I'd like to introduce Mr. Robinson Smith. Welcome
Hi,
in.
Steve. Pleasure to be here. Thanks a lot.
Before I get too far down the road, can you please make sure that I haven't misstated anything? Are we? Did I get everything right?
So far, so good,
So far,
Steve.
so
You
good.
know, my dad used to always love to ask that question. If you had the option to make your mortgage tax deductible, would you like to? And the answer, of course, was always yes.
It's always yes. Rob, can you tell us a little bit about yourself, please?
Sure. I currently live in Souk, BC, lovely Souk, down close to the water here, and I am working out of the house for the past 5, 6 years since I transitioned from working in an office as an investment advisor, helping Canadians with the Smith Manoeuvre, the strategy. I sold my business in 2018 and then made this transition working over the house, which I very much enjoy. And right now, I'm just concentrating on building out a Canadian network of financial professionals who are trained in the Smith Manoeuvre so that they can help Canadian homeowners, make their mortgage interest tax deductible, get them investing early on as much as possible, as often as possible, and getting rid of their expensive mortgages in record time because of this strategy. So we've got well, by this point, well over 100 Smith Manoeuvre certified professionals across the country: mortgage brokers, investment advisors, tax professionals, realtors, insurance agents. So all the different types of professionals that one should be looking at when buying a house or investment property, mortgages, all these sorts of things. We've got a lot of these people in the network, so they can help Canadians implement the strategy.
That sounds impressive, and I think it's one of the things that maybe we'll circle back around after you've had a chance to explain the strategy to us. But I know that there's a real advantage to making sure that you do this right. So let's talk about that as we go. So tell us, I guess there's a basic Smith maneuver that people can apply, and then there's a number of accelerators, as I understand it. And usually, when I've tried to follow this, I get caught up with the return on investment and the potential. But I really think it's important to understand the foundation first. Can you maybe talk to us about that? And if you want to, maybe show us some slides as we go so we can understand how this all works better.
Sure, absolutely. Now, in order to put all of this in context, Steve, I like to point out the challenges that we Canadians face. Excuse me. The first challenge being taxation. As you're aware, we pay some Canadians pay over half their income in tax. We pay more in tax than we do on food, clothing, and shelter combined. So we've got expensive taxation, we've got expensive housing. We all know how expensive it is to maintain a house, pay the mortgage, not to mention buy a house, and then all the other expenses of life. And so the challenge that we have as Canadians is that after we pay taxes, after we take care of our mortgage, we have very little, if anything, left over to invest for our future. And by focusing on the mortgage, because we have to, it's contract, and not focusing on investing, we run the risk of being in a very difficult place in retirement, being financially reliant on our children, having to sign up for a reverse mortgage, having to work in retirement, having to downsize, all of these things that we don't want to be forced to consider, and yet a lot of us are when we hit retirement age. So what this strategy does, it does a number of things simultaneously, and the benefits start immediately, and those are We have a mortgage. We bought a house, we have a mortgage. It's the interest on that mortgage is not tax deductible, right? Our American cousins have the benefit of being able to deduct a good portion of their mortgage, but we cannot. So it's very, very expensive. And it's taking 20, 25, 30 years to pay this off. So we've got this expensive mortgage. We're not able to save. We're facing potential of unpleasant scenarios in our retirement. We want to get rid of this mortgage as fast as we can. We want to start investing as much as we can, as soon as we can. And we want to get rid of this mortgage faster. So that's what this strategy does. Gets rid of your mortgage faster. It allows you to invest each and every month starting now, and it reduces your tax bill. And the way that this strategy functions is that it requires what's called a readvanceable mortgage. And what a readvanceable mortgage does is it allows you to access the equity in your home as fast as you're creating it. And you're creating equity in that home each and every month, every time you make a mortgage payment. Now, a lot of people have a readvanceable mortgage, but they haven't been trained how to use it to their benefit. Maybe they just walked into their bank and said, hey, I need a mortgage. Okay, the guy puts them into a readvanceable mortgage, doesn't train them on it or anything. That's not their job. Their job is to sell mortgages and get the next person in the
Mhm.
office.
Mhm.
And so your Canadian homeowner, after a couple of months of being into this mortgage, they keep on getting these statements and they see that they have a available credit that's growing each month. Wow, I'm paying down my mortgage, but they keep on allowing me to borrow money for some reason. Well, this is great. I like this trend because it turns out that each month they're giving me enough to make a BMW payment, or I can go out to dinner, or I can go on vacation.
Oops.
Oops. And so what's happening here? These Canadians are paying down their expensive non-deductible mortgage debt on one side of this mortgage and re-borrowing expensive non-deductible debt on the other side of the mortgage to buy assets which depreciate in value. Cars, vacations, motorcycles, boats, all these things. So this is one of the reasons why Canadians are in a little bit of a pickle when it comes to consumer debt. So it's important that we have the right type of mortgage to allow us to engage in the strategy, and it's important that we do it right. And I'll just, if I can, share my screen now, Steve.
Oh, let me make an adjustment here to ensure you can.
Yeah, I've just got a few slides that I'll go through just to make sure that there's a visual accompanying my explanation here.
Yeah. Rob, while I'm trying to get this selected, you wouldn't believe how many people I've had conversations with about the Smith maneuver in the last 2 weeks. It is
Oh,
like
all
a
right.
buzzword. It's everywhere. I think there's going to be a lot of people that are very interested in what you've got to say today because it is hitting home to all of us that we need to take some action, and this is one of the best ways
Absolutely.
to do so.
Absolutely. We definitely need to take action because if we don't take action, nothing's going to change, right?
Yeah.
Okay, so this is my little representation of a typical mortgage. We hear the word mortgage, Steve, and this is what we think of. We think of this one big chunk of money that we owe the bank that we use to buy our house, and over the course of time, we're going to pay that down. But this is what we require for the Smith maneuver. This is what's called a readvanceable mortgage. So we've got that same $500,000 mortgage balance in blue here, but on the other side, we've got a line of credit. Now, there are lots of different types of readvanceable mortgages out there. They all function differently, different features, different prepayment penalties, etc. This is why it's so important to get the right one for you, that you don't just walk into your bank and ask for a readvanceable, right? We've got mortgage brokers who can specifically handle your case. But in any event, as fast as this mortgage balance is going down, this limit on this line of credit is going up, meaning that the bank that offers you this readvanceable is always willing to have you owe them the same amount of money. But it's what we do with that money that's very, very important. Are we going to create wealth, or are we going to destroy wealth? So how does it work? Well, on a monthly basis, you make your regular mortgage payment like you already have been. You continue to make your mortgage payment. And as that line of credit limit increases, as much as you're paying it down by that payment, you invest. And you do that each and every month. And because you're borrowing to invest each and every month, you get to deduct the interest. Because you get to deduct the interest, CRA figures that they've taken too much from you in tax every 2 weeks over the past year. They send you a tax refund. So take this tax refund that you otherwise were not receiving and you make an extra payment against your mortgage. And as we have seen, that HELOC limit will increase by the amount that you pay it down. So you get to borrow that out to invest as well. So on a monthly basis, you're borrowing to invest whatever is reduced on that mortgage balance. On an annual basis, you're taking your tax savings that otherwise you wouldn't have received. You're making an extra payment and getting that amount invested as well. And the fundamental principle upon which all of this operates is that if you borrow to invest with the reasonable expectation of generating income, you can deduct the interest on that borrowing. So if I've got a mortgage payment of $2,200, I make a payment and $1,260 goes to interest. $1,260 goes to interest, non-deductible. This is why mortgages are so expensive. This is why housing costs so much. 940 out of that 2,200, however, does reduce principal. So that $500,000 mortgage balance goes down to $499,060.
I
And when
should
that,
interrupt you, Rob, real quick. This is assuming what kind of interest rate?
oh, this, what we're going to do, Steve, is we're going to go through the Smith Manoeuvre calculator and I can plug in different
Perfect.
rates.
Okay,
This is a
don't let me interrupt you again. Carry on.
okay. I mean, this is a relatively standard. I mean, there's a big range of where mortgage rates have been over the past while, and this slide has been in existence for a while. But
Yeah. Okay.
in order to look at principal here, um, principal PLE, we'll just use these numbers here. So we see this reduction in this mortgage balance by $940, and these two sides, as I mentioned, they speak to each other. So when the mortgage balance goes down, the HELOC side says, oh, you've paid down $940 on this side, so I'm going to let you borrow back $940 on this side. So that limit increases 940. We pull it out to invest. And what we do with this money is very, very important, as I mentioned. We need to borrow with the reasonable expectation of generating income. Otherwise, we can't deduct the interest. So this happens, as I mentioned, on a monthly basis. We pay it down with our mortgage payment, borrow it back to invest. On an annual basis, we take our tax savings, pay down, and borrow that out to invest as well. And over the course of time, we've converted $500,000 of 100% non-deductible debt to $500,000 of fully tax-deductible debt. So it's 100% tax-deductible. We've gotten rid of this non-deductible mortgage faster because of the tax savings. We're taking advantage of compound growth starting today, right? We're not waiting for 25 years until we've paid off that mortgage and freed up that mortgage payment and now we have money to invest. No, we've missed out on compound growth. We're doing so now. And we got to remember that this debt is offset by the investment portfolio, which we'll look at. So it converts 100% of your non-deductible mortgage to 100% tax-deductible debt. Each month you're generating valuable and increasing tax deductions. You're able to eliminate your expensive mortgage in record time. Each month you're able to invest money you wouldn't otherwise have available. It all happens now, happens simultaneously, and it needs no extra cash from the homeowner. As we saw, all we're doing is using the existing mortgage payment, which you're making anyways.
Brilliant. Absolutely brilliant. So, is there a right time and a wrong time in your life to actually start this?
There is a wrong time, and that is tomorrow. So
Yeah.
start it today, as far as I'm concerned. I mean, the benefit of this strategy is time.
Yeah.
That's what makes this work. Not all of us, the wealthy, have the ability to pay off their mortgage in one lump sum, but not everybody does. Very few people do. And so with our limited resources, we want to get rid of that mortgage as fast as we can, but it takes time. Now, time works in our favor though, because if we're implementing this strategy, we're starting to invest on a monthly basis. Maybe it's $800 a month, maybe it's $1,200 a month through that process. But the longer you're invested, the bigger your investment portfolio is at the end of the day, as we all know. And we're doing it via dollar cost averaging. So this strategy, what we just saw there, typically, this is the plain Jane Smith maneuver. It's as simple as it gets. And we're generally seeing 2 to 3 years off the amortization of someone's mortgage. So instead of 25 years, 23, 22. And we're seeing a net worth improvement of $300,000 to $400,000 over that original amortization period. And again, it doesn't require you to come out of pocket to generate these benefits. It's just using your mortgage payment. I mean, if you go into an investment advisor tomorrow and say, hey, I need to look at my finances, I need to improve my situation, what are they going to tell you? they're going to tell you max out your RSP contributions, uh, pay down your mortgage faster, pay off your car loan, right? Invest in non-registered investments, and all of these pieces of advice, which we hear from almost every advisor out there, require that we come out of pocket more money,
Yeah.
or we reduce our lifestyle, right?
Yeah, the financial advice we've been given is really not helping us get ahead. It's helping us stay exactly where we are.
Yeah, it's and especially the financial advice that we heard many years ago from our grandpa or uncle or our parents: be mortgage free by the time you hit retirement.
That was it. That was
What we
it.
see that in this case is, okay, I'm going to work my ass off so that I'm mortgage free by the time I hit 65 years old, and maybe you accomplish that goal, and then the next morning you're mortgage free, you're also retired. You look at the math, and you're not going to have enough for retirement. So what do? You either go back to work or you sign up for reverse mortgage. And a lot of people, they've got the goal of using their home. They think about, I'll probably use my house for my retirement way down the road somehow. Well, don't use the equity then, because at that point, you're consuming that equity. Start using that equity now and invest it.
Perfect. And so you mentioned accelerators. I'm excited about this. So there's a way to take what is 2 to 3 years that you save off your mortgage and using a few of these tricks that you're going to share with us now, um, exponentially increase that.
Yeah. Okay. So let's go back to some slides here. Um,
Sorry, what's the name of that basic? Is that just cash damming?
nope, that's just the Smith maneuver. That is the Smith maneuver. The cash flow dam is an accelerator, which we'll see.
Nice.
So there's a lot of talk out there about rental cash damming and cash flow dams as a strategy, but that is simply an accelerator within the Smith maneuver. There are a number of different accelerators, and the cash flow dam is one of them. Uh, as I mentioned, if you can see the screen here, the cash
Yep.
flow diversion, debt swap, drip, prime the pump, cash flow dam. These are all accelerators. Now, they can be individual strategies, but when you layer them in the sphere of the Smith maneuver, then things get extra powerful. So the cash flow diversion accelerator is, some people are fortunate enough to be able to invest $400 a month, and they do so on a regular basis. Their income comes into their personal checking account, and they've set up this automatic PAC, pre-authorized contribution. The investment company comes in, takes $400 and invests it. That's great. You're doing something for your future. That's fantastic. But there's a better way. What you can do is, instead, after you receive your income, make an extra payment above and beyond the regular mortgage payment, an extra payment of $400, and that $400 will become available, and then you invest it. So this isn't additional cash out of your pocket. You were investing $400 a month already. You still are, but you're going to speed up the rate at which your bad debt goes down, your tax refunds increase, accelerated on an annual basis, and you're still getting invested. The debt swap, let's say this gentleman's got $10,000 worth of, just for the sake, mutual funds that he has acquired over the course of time using that $400 a month that we just saw. If he was going to want to look at taxation here, but what he can do, if it makes sense, is sell his mutual funds for cash, make an extra payment against his mortgage, and as we know, that 500, when it goes down to 490, that 10 grand is going to be made available on the HELOC. He pulls it out and he buys the exact same asset that he sold 5 days earlier, or a different one if he wants, right? He's still invested 10 grand, but he's knocked off 10K of non-deductible debt, and he's boosted his tax deductions right off the bat there.
How frequently could a person do that? Is that monthly?
Uh, you could do it monthly. What we're talking about here is redeeming assets,
Mhm.
right? So, if I've got $100,000 and it makes sense to capital gains tax wise, makes sense to redeem them, I could redeem them 10K a month and do that if I wish.
Mm.
Um, would I do 50K for 2 months over 2 months, or just do 100K all at once? Doesn't, you'd have this discussion with your advisor, right?
Yeah. Yeah.
But one is a steady contribution, the cash flow diversion that we saw 400, and another is, oh, I've got all these investments over here. I can make them work for me right now.
Yeah.
But this debt swap can also be done with cash. Like I might get a bonus at Christmas, right? $10,000 from work. I go home, I open up a beer, I have a think, okay, what do I pay my mortgage down or do I invest it? And the answer is you do both, right? You take your cash that you got from work, you make an extra payment against your mortgage, you pull it out, and then you invest it. So that's the debt swap. The drip accelerator is my investment portfolio wants to send me $300 in dividends. I've set it up so that they automatically get reinvested. 300 bucks comes out for a millisecond and goes right back in buying me more shares of the stock or units of the fund or whatever. But if I want, I can say, you know what? I do want to see those dividends in cash. When I get that cash, I make an extra payment against my mortgage, pull that out, and I can buy the exact same stock that is sending those dividends in the first place. And so whether it's quarterly or biannually or annually that I'm receiving these dividends, I can do it whenever I receive them. Now, prime the pump, this is where this gets interesting for real estate investors because generally people have the wrong type of mortgage for this strategy. So they'll need to talk to one of our SMCP mortgage brokers and say, hey, I want to do this. Find me the right readvanceable for me. Here's my situation, my numbers, all that. Now, what happens if the appraisal of the property comes in at 625,000? Readvanceable lenders will lend up to 80%, no more, on the value of one's home. So they're willing to extend a total loan of $500,000 to this person. In this case, that is the amount of their current mortgage they have, the mortgage that doesn't work. That is their current balance. So that's okay. We're going to pay out the old mortgage with the new mortgage. I've still got that $500,000 balance, and I'm going to start doing the plain Jane Smith maneuver, maybe one of the other accelerators we saw. But I don't have a chunk of cash to invest right away. But what happens if my house appraises at 850,000? They're willing to lend me, if my credit's good enough and I'm employed and all that stuff, they're willing to lend me $680,000. But I only need $500,000 to pay out the mortgage I already have. Okay, well, they take 500 grand and they pay out the old mortgage lender. Now my mortgage debt resides over here in the readvanceable.
Mhm.
But because they're willing to lend me a total of $680,000, they give me immediately available credit of $180,000. Now we're ignoring the 65% HELOC rule here. We're just looking at concept, but the principle is the same. I may, at refinance, have a big chunk of cash that I could invest right away. Now, again, what I do with that is very important. I could pull that $180,000 out and buy a brand new Corvette. It gets me a couple of dates, but it doesn't do anything for my finances, right? And we're here to take care of our family on a long-term basis. So do something wise with it, right? You can pull some, all, or none of this, but if you do pull some, you can invest in securities, a new business, private lending. What about investment real estate? What if you've been wanting to get into the rental market? Or what if you already have a rental property? Would you like a second one, right? Let's say this guy wants to buy his first rental property. He's going to take some or all of this 180, use it as a down payment for a new property, and it's fully tax deductible. He's investing in a business, but now he can implement the cash flow down. Excuse me. So typically, what happens when someone goes out and gets a rental property is they get all excited, rightfully so. They open up a bank account, and all the rental receipts, in this case $3,000, go into that bank account. And what do? They turn right around and start paying the expenses of that rental property out of that same account. So in this case, just for ease of explanation, we're looking at cash flow neutral situation. $3,000 comes in from your renters into your bank account, and then 3,000 goes out over the course of a month to make the mortgage payment, property tax when it comes up, maintenance, all these things. But this person is missing out on a very, very valuable opportunity because when that money comes in from the renter, he can apply it as a prepayment against his own mortgage, the house in which this guy lives. Then, because I'm paying down my mortgage balance by 3,000, it becomes available on my line of credit. I pull it out and then I send it to my bank account from where I service the expenses on that property. I'm still getting 3,000 a month. It still costs me 3,000 a month, but I'm first making an extra payment against my expensive non-deductible mortgage and then pulling it out, tax deductible. And if I'm prepaying my mortgage by 3,000 bucks a month, that mortgage is gone, right? We see typically 25 years to well under 10 years amortization of this non-deductible debt.
Feel the blood pumping. Just our heart's pumping. It's so exciting.
Yeah,
So
so it's very very powerful stuff. And when you when you lay on the cash flow dam on top, use it as an accelerator to the Smith Maneuver. Now you're not only generating tax deductions through the cash flow dam, but you're also got that investment component from the plain Jane Smith Maneuver. So you're increasing your wealth even more.
Yeah, no, it's exciting. There's a lot of opportunity that comes with this, and I feel like it's like you say, the time is now. The wrong time is tomorrow. Start now. Um, so are there so if you're a real estate investor and your investment is in a corporation, is there a restriction on how you can apply this Smith maneuver to that scenario?
Uh, Not necessarily a restriction, but it's different. We know that if that cash flow dam, we can use it for rental properties that are held in a proprietorship in my own name, for example. That cash flow dam can also be used for other types of proprietorships. Maybe I do graphic design as a side job and I'm self-employed that way. I can also do the cash flow dam. But when we're talking about a corporation, that is a completely separate legal entity. Even though I might own it 100%, it's its own legal entity. And there's incomes tax implications on pulling money out, investing back into it, etc. So this is why it is so very important that people who are interested in the Smith maneuver talk to an SMCP mortgage broker, get the right mortgage, talk to an SMCP investment advisor, because you're going to want to invest each and every month into something that's safe, it's going to grow over time. And you're also going to want to talk to an SMCP tax professional to answer the questions about, okay, corporation, or I've got a JV with someone else, right? Absolutely, you can use a cash flow down with a JV, but you got to do it right. If you don't know how to do it right, don't do it. So ask someone, you know.
And this is key, right? I'm rather proud to say I'm in the process of setting up a readvanceable mortgage with a Smith Maneuver professional. So
Great,
I didn't wait for tomorrow. I started already. I'm in.
great to hear it, Steve.
And like I say, I'm excited about the opportunity this brings, and I think everybody should be, right? The taxes that I pay are gross, and I want to actually turn this into something that's a good news story real
Yeah,
fast.
absolutely, absolutely.
So, Bob, I know that you've got this amazing book. It's hard to see in the screen here, but this is capturing a lot of what you had to share. There we go. Um, and I recommend it as good reading for everybody. One of the things that this doesn't do necessarily is run through that amazing calculator of yours. So can you
Mm,
maybe give us a few
yeah,
scenarios so we can see that and see the
yeah. This will be real quick. It really, once you learn how to use the calculator, it doesn't take very long. Now, I used to have this available to the general public. I would sell this on my website. We're not selling it anymore on the website because what would happen is we'd get other financial professionals who would buy the calculator and then help their clients into the Smith maneuver without any training. And I did not want that. It's no good for anybody, not the client, not the professional, not the brand. So this is available only to Smith maneuver certified professionals. Be requested to be connected with an SMCP through our website, and they can do a scenario for you, and they can make changes, say what happens if, all that sort of stuff. But let's go through a quick one here. Firstly, um, I've got $150,000 of employment income. Uh, just forget investment income or pension income, but let's say I do have a rental and it brings in $36,000 a year in revenues. I am working, as we saw. I got an income of 150,000, so I don't need any of this rental income for living expenses. The rental expenses on my property are $32,000 a year. Let's also say that I've got um, mutual funds, spelled incorrectly, valued at $20,000. That's existing asset here. Um, well, we'll just ignore this for a second, but there's just much more functionality than I'll be able to show you considering our time here.
yeah.
Someone's margin, it depends on your province, what your marginal tax rate will be. So if it's not 40.7, then you can plug in your actual if you know it or if your professional tells you. But now we're looking at my house. I've got a house value at $1 million. and I've got a mortgage balance of five, yeah, 500,000. My mortgage rate is 4.7, let's say. These are changing all the time, and
Yeah.
it's a 25-year amortization. So there's my monthly mortgage payment, 2823. On the line of credit side of things, uh, um, let's call it, oh geez, prime just went down. What is it now, Steve? Do you know?
2.75 for Bank of Canada rate.
3.75.
So
Well, let's
typically
put
a
let's
couple
put
percent above
5.2.
that. Yeah.
I'm putting we'll put prime at 5.2. That is not the case, I don't think. I should have done my homework before I came on, Steve.
All good.
But
I'm
let's
just
say my borrowing rate is 5.7 because it's prime plus a half. So that's on the HELOC side, right? Now, this calculator defaults to an 8% forecasted growth rate, but I can add in whatever I want. If that's too low, too high, whatever, I can change that. Now, this says I've got $619 to invest. Out of the first mortgage payment after I get refinanced, 619 is going to reduce the principal. So I'm going to borrow back that 619 to invest. But the complicated part in this calculator, which the SMCPs all understand, but for someone who's looking at the first time, it's not that simple. I can I can make some changes here, and I can increase how much I have available to invest to the point of $884,000. Sorry, $884 each month. So this is step one of the Smith maneuver. When I pay down my mortgage with that payment, I'm going to borrow back what I can, and that turns out to be $884. And just that alone sees my tax deductions go from zero to $287,000 over the course of the original amortization inputted in the calculator, 25 years, which at my marginal tax rate means I'm going to get $117,000 over that course of time in the form of tax refunds. And my net worth has improved by $234,000. That is simply getting the right type of mortgage, which allows me to borrow back and invest each month over the course of 25 years. Now, we haven't seen any amortization improvement. Why? Because we haven't yet selected to take our tax savings, 117 over the course of time, and apply it as annual prepayments and get that invested. Once I do, we're going to see some years saved, and we're going to see a net worth improvement because I'm putting my tax refunds each year to work by getting them through the mortgage and then in the market. So again, this is no new cash from my pocket, but I've improved my tax refunds over the course of time to $136,000. Instead of 25 years, I'm going to get rid of that non-deductible debt in 21.5 years. And my net worth has improved by $460,000. I've got an investment portfolio of $958,000 offset by the fact that I've got fully deductible HELOC debt here of $500,000, improves my net worth by $458,000. So theoretically, I'm clear title to the house and I have $460,000 in investment portfolio.
Great.
And it didn't cost me anything out of pocket to do so. But now we look at the accelerators here, and you'll recall that earlier I had inputted that I got $20,000 in mutual funds.
Yeah.
I want to debt swap that. I'm going to sell those funds. I'm going to pay down my mortgage, borrow it back again, and buy the same asset if I want. And by taking that full 20 grand, I've now taken 5.5 years off the amortization and improved my net worth by $633,000. I can also, if I know that in 13 months I'm getting an inheritance of 50 grand, I can affect that in the future by adding in a future lump sum. No emergency cash. We don't need to put any of that to work here. But cash flow diversion. Let's say I'm very interested in what my SMCP is talking about, and I say, you know what? I like the fact that I don't have to come out of pocket each month to get all these benefits I've seen now. But what happens if I do come out of pocket by another $200 a month? Because I can afford it. I'm going to go to Timmy's instead of Starbucks. Well, if I take $200 a month as a prepayment on my mortgage, 5.5 and 633 goes to 7.3 and 842. It's the power of $200 a month, right? But I want to show you folks what this does without any additional cash flow. So I'm going to take that back out. Cash flow down. So I've entered, if you recall, my rental revenues and my expenses, and that works out to $3,000 a month I'm getting from my renter. But that property cost me 2667 each month. But I'm going to take the revenues, I'm going to make a payment against my own mortgage, I'm going to pull it back out, and then 2667 is going to service the expenses on that rental property. And the borrowing on that is deductible because I'm borrowing to invest in my business. And the difference between 3,000 and 2667 is not needed for expenses. So that's going to get invested in the markets. So once we implement the cash flow dam, 5.5 years and 633 goes to 17.25 years and over $1 million in net worth improvement. So my original 25-year mortgage, my original 25-year mortgage is gone in 7.75 years. And my net worth has increased to $1 million. A dividend reinvestment 17.25 years. If I take my dividends at 4%, yeah, that's the default, then I improve my amortization a little bit. If I weren't doing any of these other accelerators, then the drip accelerator would be much more powerful. But we know that the more you compress something, the harder it is to continue compressing it. So there is an improvement, 7.25, 17.25 versus adding this accelerator, 17.58 years saved. But without the other accelerators, this would be a much bigger improvement using this accelerator here. But in any event, why not do the accelerator? Prime the pump. This says that based on the numbers that I've inputted, I have the ability to borrow 150,000 the day that this mortgage funds. I have the ability to borrow 150,000 and get some or all of that invested in the market right off the bat.
Right.
So I could do 20, 50, or $150,000, whatever it is. But it's important to note that if I throw in $50,000 here, 1758 and 1099, 18.25 and 1508. But it's important to note here that this prime of pump accelerator is adding risk here because I'm increasing my debt. This plain Jane Smith maneuver plus any of the other accelerators, there's no additional debt you're taking on. All you're doing is converting it from bad debt to good debt and investing in the process. But if I prime the pump, I'm taking on additional debt. So I've got 500,000 of that original mortgage debt plus another 50,000 that I'm electing to borrow after I refinance and have that available to me. So this is something you really want to discuss with a professional because you're increasing risk by taking on more debt. It's good debt, you're getting it invested, but is it something that really makes sense for you? I mean, some people, when they refinance, they've got $400,000 of immediately available credit. Do they want to prime the pump with 400 grand? Some of them, maybe. A lot of them, probably not, right?
Mhm.
Given their situation, might not be suitable. But that's up to you to decide in discussion with your professional. So what this calculator does is it says if you are making the decision to take on additional debt by borrowing this $50,000, that's going to cost you $238 a month because there's a cost to borrowing that 50,000 from your HELOC. The calculator says we're going to assume that you're taking that related interest at 238 each month and making an extra payment against your mortgage so that 238 is made available on that HELOC. It can come out and service the interest on that additional borrowing. If you can't come out of pocket by $238 to prepay your mortgage and make that available, maybe you shouldn't be doing this in the first place. Right?
Well,
And
this
then
is so much magic here, so much.
lastly, we got the graph here. So this shows the amortizations green line. That's what this person was facing without the Smith maneuver, debt free in 25 years. This blue line is the compressed amortization, the conversion period from bad debt to good debt. That's how fast I'm getting rid of that mortgage debt. But a mirror image of that is this purple line. And that's the reborrowing that happens on the HELOC. Pay it down, borrow it back.
Mhm.
And the sum total of the blue and the purple line is your total debt line, which is yellow here. And then, of course, your investment portfolio is the red. So here's the conversion period where I've converted all of my non-deductible debt to fully tax-deductible debt. And here is theoretical mortgage freedom date when my total assets equal my total debt. So year 12. So here I'm debt free in 25 years if I don't do the mortgage, the Smith maneuver. But with the Smith Maneuver, I'm debt free in about 12, 13 years.
Well, this is just awesome. Totally awesome. So, Rob, I guess the next and most obvious question is how does somebody get in touch with you and or a Smith Maneuver professional? What's the conduit?
Well, on our website is smithman.net, SMITHMAN.net. And there's a couple of buttons on there. One is become an SMCP. So if anyone's interested in becoming a Smith Maneuver certified professional, a mortgage broker, investment advisor, tax professional, realtor, etc., you can click on that button, fill out the form. And the other button is find an SMCP. That's for the Canadian homeowners who are interested in this. They just go on and click the button, fill out some information, and I get that and I connect them with SMCPs that they want to be connected with. But for anyone listening and who has an interest in this, our SMCPs do take a lot of time working with Canadian homeowners. So do your research first and really make sure that this is for you. If you've got a spouse or a partner, make sure that there's a chance that they'll be on board.
Yeah.
So read the book. You can buy the book at smithman.net. If you don't want to buy it for $25, go to the library and check it out for free. But that's the first step is reading the book, and understanding what it's about. Not a lot of people are comfortable with the idea of maintaining debt, even though it generates an investment portfolio, even though it generates tax deductions, even though it gets rid of that bad debt faster, right? They're just not comfortable with debt. So you have to be comfortable with debt or be willing to become comfortable with debt, just like the wealthy are. So do your research, go to the website, smithman.net, have a poke around, get the book if you wish, and then again, find an SMCP if you want to be connected with someone who can look at your situation, see how it'll affect you.
Nice. You mentioned something earlier I should bring back up just to qualify. This Smith Maneuver is approved by the Canadian Revenue Agency, right? The CRA says, yes, this is actually good. Thumbs up, you can go ahead and do that, right?
Well, first of all, the CRA is never going to give thumbs up to anything,
Okay.
right? It either follows their guidelines or it doesn't,
Okay.
being the organization they are, which is understandable. But this strategy has been around for 40 years. And my father developed this, my father Fraser developed this back in the mid 80s. So it's been around for 40 years. We've got not one, but two best selling books. This was done by my dad, and this is mine. Um, when I was an active advisor from '06 to 2018, I had well over 500 families as clients. And among my clients were judges, police officers, lawyers, and even CRA employees as my clients. Now, the one story my dad used to love to tell was, this is obviously a while back, but he was sitting in his office in Sydney, just north of Victoria here in BC, and his assistant says, Fraser, there are two gentlemen in suits here who want to see you. Oh, send them in. So they went into Dad's office. Yeah, we're from the CRA. We'd like to hear about this Smith maneuver you've been talking about. Dad's like, great, let's do it. He got out a pad of paper and a pen, and he's doing, what we saw in the PowerPoint slides. He's doing the flow of funds and all this stuff. And he says at one point, one of the guys leaned forward and said, would this work for a $70,000 mortgage? So, and then he never heard from them again, which, like I said, is the biggest endorsement you're going to get from an organization like CRA. Right? But yeah, it's been in implementation of thousands and thousands of Canadian homes. Yeah, I mean, rules change all the time, right? There's rules that change as regards the investment environment, the tax environment, the mortgage environment. But this strategy has been in continuous operation for 40 years. So that is a testament to how robust this strategy is. And it doesn't matter about the rate environment. High rates, your tax deductions are bigger.
Yeah,
Low rates, you get to invest more each month, right? So
it's all good there. It's all good. So, Rob, one of the questions I like to ask all of my guests is to dive into understanding their why. So, you've been doing this for ages. Your father coined it and developed the strategy. You're now actually living in Souk and more relaxed than I saw you last time. I think you're enjoying it. Tell me why you're doing or continuing to do what you're doing here. What is it that's motivating you and moving you forward? What are your goals and what do you see at the end? How are you going to realize that success?
I remember when I told my wife that I was going to sell my advisory. We were living a very comfortable life. It was a very successful business. I was solely doing Smith Maneuvers for my clients, um, and it was a decision that I didn't want to take lightly, considering the success of the business. But I took her out to White Spot. Right? How romantic! And I said, "Honey, I'm going to sell the business." And I wasn't sure how she'd react given the situation. But she immediately lost 5 years off
Yeah,
her face. And she was like, thank God, it's about time. And she had known that I wanted to write a book. And I think I may have started to write a book at that time. But because my business was as successful as it was, I couldn't take on new clients. I was just, as an investment advisor, just maintaining my client base. And because I wasn't taking on new clients, I wasn't getting in front of people. I wasn't talking to them about this. I wasn't educating people about good debt, bad debt, and how there is hope and it's not all doom and gloom. And I love doing that, getting out and talking to people and educating. And so I wasn't doing that for a good number of years. And so when I sold the business, my wife knew that I would be able to get into doing something I love. And that's exactly, I was fortunate enough to be able to do that, get the book out there. Writing was a fun process, not easy, but fun. And I started this this network I've been referencing, the Smith Manoeuvre Certified Professional Network. And so now I'm training up all these professionals across Canada of various types. So I am in front of people. I am educating. And I am doing that on podcasts and webinars and live seminars and stuff, which I wasn't able to do as an investment advisor given that regulatory environment. But my why is not just because I love getting on stage and making an ass of myself every once in a while. It's because it's what I'm doing on that stage. There is so much misery in this country right now, and there has been for a while with regards to how am I ever going to be able to live the life that I have always wanted, that I feel I deserve, when I've got braces for Billy and hockey camp for Heather, and I can't afford to retire. I have to. My wife has to work, or I have to work, or both that we 3 jobs out of. You know, it's not easy out there for anybody, and this is a way that Canadians can make things a little easier on themselves, get them a little more comfortable in their lives as they live them, knowing that they're not faced with some pretty dire consequences. And you know, a financially stronger Canadian is a financially stronger Canada. So to be able to educate and give people this option, if they choose to go that route, is something that gets me up every morning. And by the end of any interview that I give, such as this one, I look back upon it and saying, Jesus, I was talking too fast. I was too excited, or, whatever the case may be. And maybe I'm right, maybe I'm wrong, but I hope you can tell that there is some passion in myself behind
I
all of
certainly see it. I certainly see it, Rob. Ladies and gentlemen, if you are recognizing the struggles, your income isn't keeping up pace with inflation, and you want to make your mortgage tax deductible, I suggest you go and check out a Smith Maneuver professional today and hook up and have a conversation. Get yourself a copy of the book, where the book go, and make sure that you don't wait for tomorrow. Do it today. This has been awesome, Rob. Thank you so much for joining me.
my pleasure.
Yeah,
Thanks, Steve.
this has been a wonderful opportunity to get to know you and learn more about this strategy. Thank you very much once again.
You're welcome.
All right.